Welcome to another episode of the Blue Fort Blueprint. I'm joined by Sayyam and Viraj. As always, people have been wondering when the markets will crash, when we'll see a correction. Since the euphoria that's been going on for the last several months, as we're speaking today, Nasdaq, which is the US stock market, is corrected already by more than 11%. Japan is in an official bear market, it's corrected by more than 25%, and India is following trends as well. Whereas Nifty and Sensex have corrected by around 4-5%, and mid cap and small cap, of course, have corrected by much more. So, guys, what's happening? It seemed like since the last several months, everything was just completely hunky dory. We had nothing to say, no negative sentiment at all. Suddenly, there's 3-4 things that have come up over this weekend, right? We're in the first week of August right now. First of all, the Iran-Israel war that's causing a lot of unrest in the markets. The yen carry trade, and we'll explain in a bit what that has caused a big correction in the Japanese and the US markets. And then, of course, the big one, which is the US recession, talks of which have been going on for the last couple of years, but finally it seems like something is happening on that front as well. So, scary times for the market. Are we going to see something big, or is it just a temporary blip that we're looking at?
I think all of these things combine to tell us one thing, that it's uncertainty which has increased again. The war, again, it seems like it might heat up. We don't know yet what's going to happen there. The US market, the jobs data came out a few days ago, and that wasn't very positive. So now again, people are unsure whether people were convinced that we had achieved a soft landing, or the US had achieved a soft landing. Whether that will continue, we don't know. So maybe the recession there will actually finally happen. The Japanese yen carry trade, which has historically caused bear markets, that has also had an impact. So I think multiple things, and the fact that the run-up has been so stark and so rapid, this was bound to happen at some point. These are just trigger events. I think there is some rational correction that needs to happen in any case.
What exactly is a carry trade?
So carry trade is basically different countries have different interest rates, right?
Correct.
The central banks prescribe different interest rates according to the country's economy. Carry trade is nothing but borrowing from a country that has a lower interest rate and investing in a country that has a higher interest rate.
Correct.
Historically, Japan, because of its high
Negative rates in
Japan. It's been at negative rates. So borrowing has been very cheap in Japan, right? Almost at nothing. Let's say the interest rate is 0%. You borrow in yen, right? Convert that money to the US dollar and invest in the US economy, for example, which has an interest rate of perhaps right now all-time high of 5.5%, right?
Right.
This has suddenly changed. What happened over the weekend or last week is Bank of Japan increased the interest rates by 25 basis points.
Correct.
So borrowing is not cheap anymore. And now because US economy is weak, it seems that US will deduct interest rates.
Correct.
Right? So that arbitrage, that riskless profits that traders, they say they were making this profit for 17 years. So it's really an end of an era, because people were making just an arbitrage or riskless profit for decades, right? And now this has made people very risk averse. Theoretically, this should not be possible, but this was something that was ongoing for, like I said, a very, very long time.
I think something like this has happened only 5 times in the last 20 years, that Japan has increased their interest rates, which is unprecedentedly. They were not supposed to increase it by 0.25, which they have. So right now they are in positive, the interest rate, which has not happened in Japan since a long time, right? Which is why you can see Japan's own markets, I think today they fell by 13%. It was another 10% on Friday,
right,
which is a 25-26% since the last high of July 9th or July 11th. So the idea is that's not only Japan, even Taiwan, it's the worst fall in 57 years. US, we already saw around 2.93 trillion eroded out on Friday. Today we are yet to see what happens. Indian markets, right, still seem to be resilient, because in spite of what happened today, it's 2.33% in Sensex and Nifty, and 4% in mid cap and small cap.
Yeah.
So I believe we've not seen that fall that that the other countries are seeing, which may not be healthy. To be honest, we should be in line with the global markets to a certain extent, right? Completely being off it may not be that healthy for our market, because when it happens, it's going to be worse.
But I think there's, my personal opinion, there's good reason why India has not fallen as much as the US and Japan. Let's take a look at what happened in the US in the last 1.5 year. It's really 6 or 7 companies that's pulled the entire stock market forward. So US had become so polarized, where everything apart from the Magnificent Seven, right, they call it, nothing else was working, right? So the small caps, mid caps, nothing was working, which is very, very opposite to what happened in India. In India has been driven by small caps and mid caps and just a broad market rally in general. But in the US, it was only tech. Now tech had become so overvalued, not maybe overvalued, but had run up so much and everything else was doing so badly that this correction that can happen can be a lot more drastic. And because they had run up so much, the weightage in their indexes of these magnificent 7 companies, right, had become so large that that was bound to correct. Therefore, funnily, what's happening is that the US market, despite their mega caps are going to correct by about, let's say, the potentially 10-15%, whereas India is going to be very, very different. So now it's funny, in the last 1-2 years, India has almost become a safe haven for investors compared to something like a US or other developed markets, right? So I would bet my money and I would keep my money in India because that makes me safer, especially with now the rupee being a lot more stable than what it used to be in the last 4 years or 5 years.
Yeah, I think just to add to that, other than the markets, the economic aspect as well. If we see in the US, it literally only tech that's driving it, that's driving the hiring, the spending. People are investing in AI and machine learning, things like that. But if you see everything else, normal consumption has really slowed down over there. So that has slowed down in the US, real estate prices and this. We see China consumption slowing down. The 2 largest economies in the world, their consumption has slowed down significantly. So I think that really, of course, that has to have an impact on the stock market. The saving grace for India is that consumption has actually been very strong. We are now seeing that the what was weak in India was the rural market, but even there we're seeing green shoots where that's picking up again. So I think India is very insulated in that sense.
According to me, the US Central Bank, right, the Federal Reserve, they have been quite slow in reacting to reducing interest rates, right? They should have understood that the broader economy is in pain, and the economy is not just driven by tech. So I think they've been a little bit slow. I can understand why they've tried to delay cutting of the interest rates, especially with how persistent inflation has been. But perhaps they should have done it this time already. They met last Wednesday, or they should try and do it as soon as possible, because now people are anticipating that they will start cutting interest rates a lot more aggressively. But I don't know if you guys think it's a little too late.
I think this seems to be a bit of a trend where initially they're like, no, it's not an issue. So if you remember after COVID, when they started hiking interest rates, for the longest time before that, they said that inflation is transitionary. So we don't really need to increase the interest rate so much. And then when they started doing it, they went overboard with it. So maybe again they're just putting it off now, and then they're going to start cutting significantly again.
Yeah. I mean, US elections are also coming, so historically, while elections are there, they do start cutting interest rates to boost the economy. That's generally what the parties want, right? So now the question, guys, is that what should one do as an investor? Suddenly, we spoke about all of these risks emerging, which were literally until last week was not there. None of these risks were there. If you ask me, how is it going? Everything was hunky dory, right? So, what needs to be done as an investor apart from those? Is it the same Ghisa-Pita answer? Continue your SIPs, keep investing lump sums. But what is the change in strategy that you guys are seeing for clients?
Look, honestly, a lot of people have been sitting on a lot of cash because markets did not correct at all, right? There was a small opportunity during elections that was one day, and after that again markets just went up, right? So in terms of the Ghisa-Pita answer, yes, a part of that, continue your SIPs, continue how you've been investing, don't stop that at all just because of a certain panic situation. Markets, of course, fundamentally we are seeing all these problems, but then the panic is struck by fear. कि अरे आज गिरा है तो कल होगा, परसों होगा, and all of that, right? So don't get into all that because your SIPs, as you mentioned when you started them, they were 3 years, 5 years, 7 years with that horizon, correct? So continue that for that particular time. In fact, I would say you should be more aggressive in certain, if let's say a war scenario, a carry trade scenario, or some other jobs data or whatever scenario, right? I feel we should be more aggressive in these stages because we've seen before that wars do not affect our markets as much. We've discussed about it also of how war affects financial markets. The carry trade right now, it should be okay once the margin calls and everything is sorted out. So there is no reason to panic. Continue your SIPs, and I would say please put in more cash. If you do
because the problems seem to be global, not local.
Correct.
And the good thing is that now Indian markets don't rely on FI money as much as they used to, because we have so much domestic flows coming in on a monthly basis that our markets will not get affected. And the fact that our markets have corrected only 4% is a testament to this, while larger markets have corrected up to 25% as we
Double digits,
discussed in Japan's case. So what I would do with my money is that every fall of 2%, 3%, 4%, right? I would keep staggering. If I have a lump sum, I would keep putting in a little more money. I think this is a good opportunity of buying for a country that remains a very good long-term bet, for the next 3 years or 5 years.
Sure.
I completely agree. I think it's important to have a structure that for this kind of fall, this is what I would do. Keep that in mind, because when it does happen, people kind of lose their wits. Stay away from the extremes. Sometimes people are like, okay, you know what, I'm going to sell everything and just sit on cash. On the other hand, people are like, okay, dip aa gaya, main kharid leta hu. Don't do either of the extremes. Have a kind of formula in place, a framework which you can follow, and do that. Additionally, I think there is a bit of churn you can do in your India portfolio as well. I think try and move your portfolio a bit more towards large caps. If there is a correction, small caps are bound to correct more. They have also run up a lot more. So I think a bit of churn there, some profit booking in small caps, and investing in large caps, particularly sectors which have not done as well. FMCG, banking, things like that, traditional good quality sectors.
IT, pharma, chemicals.
Exactly.
Yeah.
So I think there is still scope and opportunity in the Indian market, and there are of course certain pockets which are overheated. So just shift from the latter to the former.
Yeah, I think that's very good advice for people who have limited capital, people who are fully invested. They need to consolidate and maybe rotate their portfolio into large caps and maybe rotate their sectors. For somebody who has a monthly cash flow coming in and who can invest more, definitely do that. This is a good opportunity for you to add to your India portfolio from a long-term perspective, of course. So I think this was a discussion on what's happening right now in the markets.
Just one more point I'd like to add. I think expectations need to be a bit adjusted. What's happened in the last 1 year, it's been very easy to make money in the Indian market, in the global markets. I think that's not going to be the case anymore. So just temper your expectations.
Yeah, I think in the last 3 years, CAGRs in anything has been upwards of 20% easily.
Yeah.
But going forward, maybe, what do you guys think, 12 to 15%? Even if we get that, I think we should consider ourselves lucky. Yeah. 12 to 15% is honestly a great return. People have forgotten what equity markets are supposed to give in the long term.
Yeah.
So anyway, that's the discussion on what's happening right now in the markets. But a couple of weeks ago, we also saw the budget, right? And the budget had some significant announcements which are going to have a long-term impact on a few of our asset classes, right? So we just wanted to talk about, I'm pretty sure you all saw the budget and what were the announcements made. But now that we've pondered a little more on it and we've understood it, there's going to be significant changes in the potential of returns that some of these asset classes are going to give, especially gold, real estate, and equity. Right, so maybe one of you can start off with any one of these asset classes and talk about what the announcement was and how that impacts that asset class for the long term.
So I think the major one that most people are aggrieved by is equity. The capital gains, the long-term capital gains has been increased from 10% to 12.5%. The problem is that most people don't like change. The tax is increased, and obviously people won't be happy about that. My point of view is that it's still the lowest tax bracket of anything, right? That is point number one. Point number two, it's still the highest earning potential asset class of anything. If you look at both those things combined, it really does not make that much of a difference. Then in that case, if I say that forget what it was before, if I say that the taxation of something is just 12.5%, objectively, you would think that's still a pretty good tax rate, right? So I would say that when it comes to equity, the perception shouldn't change too much. It's completely fine. You can continue to invest. The short-term tax rate has increased more. It's gone from 15% to 20%. In any case, equity is an asset class that you should have a long-term outlook in. You should definitely look to hold something for more than a year. So from that perspective, I think it's not that big of a negative.
I think budget overall, right? What people said that it wasn't that impactful, or it was just a budget just for the sake of it, right? But if you read between the lines, what they've nicely done is they've rewarded the long-term investors. See, taxes were going to increase in a country as they get developed. 10% is not the norm. It has to be higher than that or whatever. We might see further increases also. We don't know as of now. But the idea is people have made a ton of money in the last 4 years, in the last 5 years in the equity markets, right? That's because you're in the country. So anyone complaining that, okay, why have they raised the taxes from 10 to 12.5 or whatever, that's a 2.5% gain for 3x, 4x, 5x money that you've made, yeah? So I think that's completely okay. It's not a big deal. And by doing 20%, by changing the short-term tax to 20%, they have also said that all that you're trying to do by flushing in liquidity, just aaj le liya, kal bech diya, just increasing the volumes, right? That has to curb down for sure. They've also increased the STT. They almost doubled it.
Correct.
So all the FNO and all of this short-term trading has to curb down, because now again 5% is a decent enough increase. I would say 20% if you're letting go.
Yeah.
So that will be a good thing for the markets in terms of just the liquidity control.
I think after this announcement was made, one thing that a lot of clients started asking me was, what if they increase the equity taxation from 12.5 to 15 to 20 to 30? We have no control over it. अपन क्या कर लेंगे अगर ऐसा हो गया तो what can we do? See, generally what happens is that capital gains, especially on something like equity, is not taxed at the same level as your income is. The reason is because the government needs to promote capital, right? Especially in a developing economy like India. Even in developed economies, what I've seen is that the capital gains interest rates on equity is generally about half of what their maximum income tax slab rate is, right? So, for example, in the US also, if the maximum tax slab is 40%, उस बंदे को capital gain जो देना है equity पे, it'll be around 20% or 15% only, right? So the chances of your equity taxation going to 20% or 25%, 30% is highly, highly unlikely unless the government's completely lost their minds, right? In which case the equity markets will completely crash, and the chances of India becoming a global, developed nation goes down significantly.
Also,
So,
I think then that government won't really stay in power.
They won't stay in power very much longer, and the government understands. So ऐसा नहीं होता है that just because they've increased it, they're going to further keep increasing to some ridiculous rates.
In fact, they're thinking about it from a futuristic level where all assets are kind of they've mentioned that okay, these are similar assets and will be taxed similarly.
Correct.
So the taxation which was complicated before, kabhi indexation tha, nahi tha, kaun sa long term, short term, 3 years, whatever it was all kind of mandated similar levels, right?
Correct.
Real estate, no indexation, 12.5%, equity, no indexation, 12.5%, fair enough, same taxation. Debt mutual fund, we saw last year what happened, right? They made it as good as FDs. So thing is, all asset classes, at least similar ones, will be on the same level, which is okay. Did you guys see what happened with gold?
Yeah, gold is interesting.
The entire, it's not a scam per se, but what people are upset about.
The SGBs you're talking about.
The SGBs, right? The first tranche in 2016 was maturing this year. People have held it for 8 years, enjoyed a meager 2.5% interest, and they thought, "Okay, chalo, tax free ho jayega, ye ho jayega, we'll get a good rate." And gold has shot up in the last 3 years. Like, literally, they've moved from A to B. It's crazy.
Correct.
And what they did was, on the day of the budget, they announced that there'll be an import. I mean, they'll
Custom
reduce
duty was
custom
cut,
duty by 9% or something.
Correct,
So
correct.
gold since then, and silver of course, they've seen a fall of 20 to 22%,
Correct.
which is maturing in August right now. So investors, right? So let's say 100 had become 200, that has come down to 175.
Correct.
So that's an actual loss of returns, and it technically reduces government's liability, right?
Yes.
Yeah.
So people are saying that of course they've done it deliberately, and it could be, but yeah, it is. I mean, if I have held for 7 years, 8 years, और मेरे साथ ऐसा हो तो बुरा तो लगता ही है, no matter
Of
what.
course.
To be honest, the government at any point in time cutting duties is always suspicious. Like
Exactly.
They never cut taxes or duties, right? So
No,
what's
100% the government is trying to reduce the liability in this, which is why, sovereign gold bonds is supposed to be the best way of investing into gold.
Correct.
Right? A lot of influencers and a lot of people like us have also said कि gold करना है, sovereign gold bonds ही करो. But I think I've always been a little apprehensive, right? And there have been other people also in the market who've said that it's perhaps not the best. First reason is that एक तो 8 साल के लिए आपका पैसा lock in हो जाता है,
Correct.
right? So what's going to happen after 8 years? It's really the 8th year that will tell you how much of a return you've made. Like in 8th year, this happened.
Exactly.
Right? The government
Correct.
announced this. When you have a very specific lock-in period, that becomes an issue, and you can't take your money before. Now they do that with the giving that lollipop of 2.5% interest and tax-free returns. But आपका return ही उन्होंने significantly CAGR कम कर दिया by making this one announcement. So you've given control. It has nothing to do with gold. It's actually like a government bond that you're buying, if you think about it, right? It has nothing to do with gold. So maybe physical gold is still, or doing gold ETF or a gold fund is probably maybe the best way to invest. Keep your money liquid here. Don't give your money's control to somebody else. Keep your money as liquid as possible. You'll still probably make the same amount of return that you will if you lock in your money.
Correct.
One change in taxation of an asset class which has kind of flown under the radar is international equities. The taxation for that has now come down to 12.5%.
Yeah.
A lot of people who say work for Microsoft, Amazon, Google in India, they're sitting on stocks of those companies, significant amounts, and those companies have given great returns, significant returns. So the benefit of a much lower tax rate is hugely helpful. Not just that, in funds which invest in international stocks, which we've spoken about in the past, those have become a lot more attractive. Which used to be taxed at slab rates are now taxed at only 12.5%.
Yeah, I think that's a very, very big.
And no one's really discussed that, so I think that's a great thing that they've done. They've again aligned it to a common rate.
It's uniform basically. Now you don't have to worry about taxation. आप कुछ भी खरीदो बेचो long term है तो 12.5.
I think overall what they were trying to do with this budget is simplify the taxation with capital gains and also with the income tax slabs. They're trying to get more and more people to move to the new regime, which has lesser exemptions, but it's like a simpler version of it. So I think over time they want everyone to move to the new tax regime and just phase out all these multiple different exemptions, which is very confusing to someone that doesn't understand tax or finance. So they're just trying to simplify everything.
Yeah, so just to conclude, I think asset class wise for equity, don't think it makes much of a difference. It is what it is. It's neither good nor bad. For real estate, it can be good or bad depending on your holding period of the property and how much return your property has given. For gold, it's not been a great budget. People especially who invested in sovereign gold bonds, they've lost out big time. Gold is corrected because of the announcement in custom duties. For international equities, it's great, and you should definitely have some portion of your equity portfolio in international stocks. Don't keep it all India, just for the purpose of geographical diversification. And there's some industries, we've discussed it before, that just don't exist in India, and therefore you should invest probably in US. Some portion of your capital should be invested in the US. So thanks for watching. Please do like, share, subscribe. Let us know what you think. Put some questions in the comment section so we can answer them like always. Thank you. We'll see you soon.